Our next guest says that the economy is probably taking the scenic route to a recession, not gliding towards a soft landing. Joining us right now to explain is Joe Amato. He is President and Chief Investment Officer at Neuberger Berman, which has more than $440 billion in assets under management.
God, how do you sleep?
Yeah. Joe, it's been interesting times, and you're not sleeping well.
It has been interesting. While there's a lot going on in Washington that you guys were talking about recently, there's certainly, I think the real story has been what's going on in the bond market. I mean, we've seen an enormous move. Yields are up almost 100 basis points from just the summer. And it's interesting to see how equity markets start to react to that. We saw that certainly yesterday and sort of the headwinds over the course of the last few days. But, I think until we see some stabilization in fixed income markets, I think it's going to be, continued volatility in equities.
What's behind this move? If it's the market's actually getting ahead of the Fed at this point, what's driving the market?
Well, on the long end of the curve where we've seen the major move, it's interesting. You haven't really seen a change in expectations on growth. You haven't seen a change in inflation expectations. Right. So it leads us to conclude that there's got to be technical reasons and just the good old-fashioned supply-demand and realization that there's going to be huge amounts of supply, and we haven't seen as much buying outside the U.S., and I think that's one of the reasons that things have backed up. And, when the bond market moves, it usually moves fast and violently. So, right now it's like trying to catch a falling knife. So
we've talked about this a little bit, just the idea that the Fed is trying to not only keep rates higher for longer, but also do quantitative tightening and shrink their balance sheet, which in real terms just means they're not going to be buying as much of the supply that comes out. Can they continue on that path with all of these things setting up? And I'm not talking about this year. I'm not even talking necessarily about next year. But is there a point where they have to either stop letting these treasuries roll off, or they have to actually become a more active buyer?
I think they're determined to roll off and reduce the balance sheet. I mean, the balance sheets, as you guys have talked about, we've all talked about many times, have increased dramatically into levels that you never would have thought of, 20 years ago, 10 years ago. So I think they have to roll that balance sheet off. I think the issue is what they do on the rate curve. My view is that we've seen the last of Fed hikes. I know the market's pricing in hikes later this year, but the headwinds that we see and the recent increase in the long end just tightens financial conditions that much more. So I think those headwinds are building up, and I think the Fed's got to realize that and be more careful here in their policy decisions over the course of the next 6 months. And then even thinking through 2024, when you have real rates, it's, getting almost to 2.5%. I mean, you're really tight from a financial conditions standpoint.
The next move will be a cut, not a hike.
That's my view. We debate that in our fixed income team.
That will come later this year, early next year, late next year?
I don't think it's this year. I think our view is you're looking at sort of mid-24 before you see a cut. Of course, in a data-dependent environment, if things get much weaker, if we see a really bad number, I don't know what a bad number is on Friday, employment. If you see either strong or weak employment numbers, that may change the outlook for the market on Fed hikes.
What do you do with equities at this point if you're worried about a recession coming, not a soft landing, if you're worried about margins tightening?
I think you want to stay up in quality. I mean, we've had that view for a while. It was not the right position, the first half of the year when you saw, high beta rally in a meaningful way. But I think staying up in quality, companies that have low financial leverage, ability to protect margins, a bit more defensive in their business models, I think you're better suited. We're not saying don't own equities, because the pathway to a soft landing is still there. Mm-hmm. We don't think it's highly likely, but it's still there, and you want exposure to that asset class.
Well, stocks have come down, but you're still talking about the S&P up 10% for the year. You're still talking about the NASDAQ being up north of 20% for the year. Are stocks cheap here? Are they?
I think valuations are there's a lot of dispersion, right? We've all talked about this. You have a group of stocks of, the Super 7, if you will, that are trading 30-plus times earnings, and you got the rest of the markets at 16 times earnings. So the rest of the market doesn't look screamingly expensive, per se, particularly if earnings stabilize. Right now, in third quarter, the expectation is for essentially flattish earnings. But if you carve out the Super 7, earnings are actually going to be down 8% right now as the consensus. So, that's what we're looking at, even though valuations on the surface don't appear that aggressive.
But it doesn't look cheap to you right now.
I think there are sectors that look cheap. I think, if you look at the defensive sectors this year, whether it's healthcare, utilities, consumer staples, they've actually not done well this year, right? They're down, right? So I think moving into those sectors, being a bit more defensive as we move into continued headwinds makes sense.